All right, welcome back to another explainer. Today, we're putting on our expert investment analyst hats. We're going to take some legendary investing frameworks and apply them directly to one of the most talked about stocks on the market today, just to see if the hype actually matches the math. We'll be digging into the cold, hard data to separate the true underlying business value from the absolute market frenzy we're seeing right now.
Okay, let's jump right in. We've got to start with CEO David Ricks's massive Q1 2026 announcement. He highlighted a blistering 56% revenue jump, bringing them to $19.8 billion. Think about that for a second. That is the kind of massive revenue acceleration you almost never see in a mature mega-cap pharmaceutical company. And it's being driven by this absolute surge in demand for their GLP-1 weight loss and diabetes treatments.
And that phenomenal growth has propelled Eli Lilly, ticker LLY, to a staggering market cap of roughly $1.077 trillion. Now you know as well as I do, when a company crosses that trillion-dollar threshold, the fundamental question shifts, right? We stop asking, is this a good company? And we have to start asking, is there actually any room left for this stock to grow?
So here is our roadmap for the Guru Gauntlet today. We'll kick things off with a company snapshot, then we'll run the numbers through the Buffett lens, the Peter Lynch lens, and the Benjamin Graham lens. After that, we'll check out some DCF and alternative valuations, and wrap it all up with our synthesis and final verdict.
Starting right off with Section 1, Company Snapshot and Fast Facts.
Let's get our bearings. Lilly is sitting at around $1,078 a share with a premium trailing PE of 38.3. This is driven almost entirely by the explosive demand for their GLP-1 obesity and diabetes drugs, namely Mounjaro and Zepbound. But here's what's really interesting. Despite this massive premium and the huge fundamental growth, the stock is basically flat year-to-date, up just 0.2%. So investors are clearly weighing that high current multiple against a forward PE of 24.3. Basically, they're banking heavily on future earnings catching up to today's price.
Okay, Section 2, the Warren Buffett lens. Let's see what the Oracle of Omaha would think.
So we know Buffett is always hunting for a competitive advantage, right? Well, he would absolutely love the wide economic moat Eli Lilly has built. They essentially operate in a duopoly for these GLP-1 drugs, and man, that pricing power is clearly reflected in their incredible 43.07% trailing 12-month operating margin. Management is also aggressively securing their future with strategic acquisitions like Orna Therapeutics. But, and it's a big but, Buffett might definitely raise an eyebrow at the elevated debt levels required to actually fund this rapid global expansion.
And this brilliantly illustrates Buffett's biggest hurdle when calculating his absolute favorite metric, owner earnings. Look at this. While the company prints about $6 billion in free cash flow annually, they are being forced to commit a staggering $50 billion in capital expenditures just to build the manufacturing capacity to keep up with demand. From a Buffett perspective, if a business has to constantly reinvest massive amounts of capital just to maintain its moat and meet demand, well, that eats right into the true cash left over for the owners. Because of this lack of clarity on long-term free cash flow, Buffett's required margin of safety, it just isn't there at current prices.
Let's flip the script, moving to Section 3, the Peter Lynch lens.
Lynch loves to categorize companies into buckets, slow growers, stalwarts, fast growers. So is Lilly a fast grower? With Mounjaro sales up 125% year over year in the first quarter, yes, Lilly absolutely fits the profile. This is exactly the kind of dynamic revenue expansion Lynch was always hunting for.
Which brings us to the crucial point, the PEG ratio. That's price to earnings relative to growth. If we take their high 38.3 trailing PE and divide it by their blistering 44.7% year-over-year total revenue growth rate, we get a PEG ratio of roughly 0.85. Now for Peter Lynch, a PEG under 1.0 is literally the holy grail. It means you're paying less for a unit of growth than the market usually demands. Lynch would typically view this as a screaming, undervalued buy signal.
But hold on, before we get too excited, let's look at the insider data. Lynch always looked at insider buying as a major vote of confidence. And the data we have here is a bit of a sobering reality check. Over the last 6 months, 0 insider purchases. None. And on the flip side, 32 massive sales totaling over $326 million. Now sure, insiders sell for all sorts of reasons. Diversification, taxes, buying a yacht, whatever. But the absolute lack of buying at these trillion-dollar levels might give a Lynch-style investor a slight pause, even with that beautiful PEG ratio.
All right, time for a serious reality check. Section 4, the Benjamin Graham lens.
Graham is the godfather of deep value investing, so his defensive investor checklist is notoriously strict.
Let's run it. Adequate size? Yes. A $1 trillion market cap clears that easily. Earning stability? Absolutely. Their Q1 EPS jumped 170% to $8.26. Dividend record? Yes. They recently raised it to $1.50 a quarter, though let's be real, the yield is a tiny 0.6%. But here is where it falls apart. Moderate price to earnings and price to book ratio? Hard no. A PE of 38.3 completely fails his value test. It's way outside his defensive limits.
In fact, if we force the math using Graham's famous intrinsic value formula, taking the square root of 22.5, multiplying it by the trailing EPS of $28.20, and then multiplying by an assumed industry average book value per share of $15, we get a brutally low intrinsic value of just $97.55. At over $1,000 a share today, Graham wouldn't touch this stock with a massive market crash. It is fundamentally incompatible with traditional deep value investing.
Okay, let's leave the history books for a second. Section 5, DCF and Alternative Valuations.
Since our sources didn't give us a precise weighted average cost of capital, or WACC, or a terminal growth rate to work with, we went ahead and built a sensitivity table. So assuming an 8% WACC and a 3% perpetual terminal growth rate as our base case, you can really see how heavily this valuation depends on those estimates. If Lilly can maintain these incredible cash flows through 2026 and beyond, today's price might actually be fair value. But if you see even a slight uptick in the discount rate, or if terminal growth expectations drop, the intrinsic value completely plummets.
And what about other models? Well, the dividend discount model severely undervalues Lilly because of that tiny 0.6% yield. Growth companies like this just don't return enough cash via dividends to make that model work. And if we do a comparable company analysis, it confirms that Lilly is trading at a massive premium. At a 24.3 times forward PE, it vastly outprices its slower-growing pharma peers like Johnson & Johnson or Pfizer. You are absolutely paying a premium for that monopoly-like growth runway.
All right, let's bring it all together now. Section 6, Synthesis and Final Verdict. Our Guru scorecard presents a really fascinating split. Peter Lynch and Wall Street analysts, who currently have a median price target around $1,265, are screaming buy based on that explosive 44.7% growth and a super favorable PEG ratio. Meanwhile, Ben Graham is screaming sell because there is literally zero margin of safety. This leaves us with a synthesized verdict of a cautious hold. The underlying fundamentals of the business are incredible, no doubt. But as an investment today, your success relies entirely on them flawlessly executing that $50 billion manufacturing expansion and successfully fending off competitors. Which brings us to the ultimate question. Considering this really rich valuation stacked against that unprecedented 56% revenue growth in Q1, at what price does a miracle drug become a risky investment? Look, if you believe obesity and metabolic disease treatments will just keep scaling globally without any major pricing regulations getting in the way, then the growth absolutely justifies the premium. But if margins start to compress, or if the supply chains stumble even a little bit, the math is going to catch up very quickly. Thanks so much for joining me on this explainer, and I hope this structured dive into the numbers gives you a much clearer view of Eli Lilly's trillion-dollar run. Catch you next time.